Welcome to the Real Advisor Podcast. TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear Trappists. Welcome back to what many people are calling episode 66 of the Real Advisor Podcast, TRAP, TRAP. Carl's just made it in. My name is indeed Lick Ninken, and joining me as ever in the digital studio of doom are the three other horsemen of the apocalypse. Carl Delavocci, would you?
Hello.
Andy Ultra Heart, and
Evening.
Alan the Storyteller Smith. Now, gentlemen, we have a show packed full of absolutely nothing. So let's start unpacking it straight away with some more high-energy review reads read out by my very good friend, Andrew Ursane Hart.
Thank you, Nick. You're a pro, aren't you, mate? A couple of reviews today. First one is from Ben Hayward, entitled No Frills, Simple but Reassuringly Brilliant Advice, Tips, Insights and Banter, 6 stars. Having left a large national restricted advice firm to set up a new IFA business, I found this podcast a complete godsend. I've learned and implemented so much from what I have heard on here, and the fact that our fledgling business survived the first 12 months is now is now thriving is in no small part down to these 4 splendid chaps and Nick's awesome Google group. Haven't got a Google group of you, Nick. An absolute must for any advisor, no matter the stage in their career. Even got to meet Alan and Andy today at Hum, disproving the adage of never meet your heroes. Final one is from Clive Thompson, fellow colleague, ex-colleague of mine, good guy, entitled A Constant Source of Inspiration and Insight. As a regular listener of the Real Advisor Podcast, I love the format, the stories, the insights, the banter, and even Nick's sound effects. Your interview with YouTuber James Shack in episode 57 was eye-opening, not only in hearing about the incredible success he's achieved in building his business and attracting new clients, but the simple way he's packaged up and showcased his expertise. It was amazing. Congratulations, Trap Pack, for building such an indispensable resource for both seasoned and aspiring financial advisors. 6 out of 5 stars. Keep up the fantastic work. Back to you, boss.
Well done, Andrew. You got there. Very good. Thank you,
Just
dear Trappers, for
about.
those reviews. They are, they just mean the world to us, and they keep us going. And do, of course, leave a review on iTunes or your podcast app of choice if you're allowed to. 6 out of 5 stars is the mandatory minimum. Now, episode 66, let's put a topical timestamp on it. What's going on in the world? Well, there's one big thing going on in this thing of ours. Ultra.
We have some very exciting news. Trap Live 2025. We've finally got our act together, and we have the tickets now ready.
Woohoo! We didn't really.
Let's just say there's been quite a bit going on behind the scenes. But anyway, we are ready to launch. We've emailed our list. If you're not already on the list, you should subscribe to it. But anyway, the tickets are now live, and the best place to find them is go to the website, all one word, The Real Advisor Podcast, advisor with an E.com. Grab your tickets there. We're very excited to see you there. We have some us 4 there and some other familiar faces. We've got Samantha Russell doing a talk and a few other, hopefully, special guests at the Royal College of Physicians in Regent's Park, which was the ex-home of Humans Under Management. If you've been there before, you know it. 6 till 9:30, so grab your tickets. We're looking forward to welcome you, aren't we, gentlemen?
Yes.
Yeah.
So excited.
We've got a couple of months to work out what the hell we're going to be talking about, but it'll be good, as you say. Yeah,
we hope it's going to be a lovely sunny day. We've got access to the garden. It's a wonderful venue, so please do come along. Also, just to mention, it's sort of sandwiched between a couple of other events. In the day, there's the Brett Davidson conference for his sort of subscribers and people that are part of his course, and the following day, it's our good friend Abraham Okinsanyo's Advisor 3.0. So if you're in London, you got a triple whammy. Obviously, we know what's going to be the highlight, but it's up for you to decide.
I think Abraham is even more of a friend of the show at the minute, isn't he? I think we really love Abraham, don't we? Abraham.
We love Abraham.
Don't. So, yeah, therealadvisorpodcast.com. Grab your tickets.
Okay, great stuff. Great
Just before we go on, like if people only knew what went on in the background to get to this moment, right?
Yeah, like you've got to come and support us.
I mean, to be fair, I mean, putting on an event is difficult, isn't it? I mean, Andy's been putting them on for years, but oh my God, you think we'll just, you think it's going to be simple, but
there's so many other people going, no, I think we should do it this way. So.
Yeah, there's so many moving parts.
No strong opinions by any of us, was there?
No.
We got agreement in the end.
Yeah, we'll do whatever you say, Andy, but we'll pick up on everything you do.
Yeah. Go ahead and do it, and then after you do it, Jesus Christ, why did you do that?
Yeah, the wrong email, the wrong framing, the wrong date, the wrong time, the wrong pricing. Anyway.
It was totally the highlight though of this journey so far last year, wasn't it? It was just amazing, and we had so much fun putting it on, and the meeting everybody afterwards. It was brilliant. So look,
I think that's the thing, Carl. It's this thing called community.
Yeah.
People like-minded. It's a self-selecting audience. People who listen to this, they're all on a journey, all trying to improve, all sharing best practice and ideas. And you get in a room with another 150 or so, or more possibly, of like-minded people. It's just fun, isn't it? And it's kind of late afternoon, early evening, so you can do your whatever. You attend other conferences, do your work, come along for the evening, have a couple of drinks, and mix and mingle. It's it'd be great. It'd be amazing. It'd be fabulous.
It's a fabulous echo chamber with alcohol. It's just incredible.
What more?
The favourite kind of chamber.
We are all going to tell each other how fantastic we are, how correct we are, and how we should
Don
all
Draper lives.
just
That's
keep...
a great way of describing
How
it.
everyone else is strong.
Yeah.
All right.
Okay.
Yeah, brilliant. Well done, everybody.
Okay, brilliant stuff. Okay, let's move on then with the topical tidbits as they normally are. So we're starting off only still with you, Mr. Hart, your dulcet tones. You've seen
back to
some Norwegian guy.
I mean, we bang on about this sovereign wealth fund in Norway quite a bit. So it's run by a very charismatic gentleman called Nikolai Tangen. And me and Storyteller had the pleasure of going to see him this Monday, this week, at LBS, London Business School. He was doing a talk. They do, I think it's called Summit Series. They have sort of business leaders coming in. He was obviously a huge oversubscribed guest, so they had to move to a bigger room. Probably about 200 people there, wasn't there? And he got interviewed on stage. He shared a lot of very interesting insights. He runs his own podcast called In Good Company. Mentioned it here a few times. He's a great podcast interviewer. Not a very good interviewee, was he, Alan? He was quite sort of standoffish, angry. Body language wasn't right.
Yeah, it was a nice event. The interviewer, I think, the interviewer was an academic. I think he was a dean or assistant dean.
He was well researched, but
he was well researched, but he wasn't like media professionals like we
like we are. We're both sitting there saying we're doing a much better job.
Well, you can imagine. This guy needs our help.
But there was
it was good.
There were some good insights. He's obviously a sort of wealthy guy now, and he basically mentioned a couple of things like, why do rich people moan so much? That's what he mentioned. People said, what should you spend your money on? He said education, and then he said friends, family, and experiences. So a few of the sort of themes that we talk about. He was very pro-technology. He was just saying how as humans we advance very, very slowly compared to technology. Like his example was the 100 meters final. Every 4 years, 100 meters final in the Olympics, it improves by 0.01%. He said in the same time, technology's improved by 100x and then 1000x or whatever it is. Anyway, the point of my topical tidbit is his fund, the Norwegian Sovereign Wealth Fund. Profits in 2024 were a whopping, the returns 222 billion. And he also said on the night, their aim is to own 1.5% of all global public equities. And their split, actually, as we've spoken about before, is 70% global equities, 25% global bonds, and 5% other stuff, physical property alternatives, some long, short hedge fund stuff. That was it. Renewables as well. It was also very, he just said, we just focus on the finances. Like we avoid some things, I think they avoid tobacco, but apart from that, it's all about making money. So that was it. Did you enjoy your night, Alan? I introduced you to LBS and the Summit Series for the first time. You were like, I could do this. I could do a degree here. You were getting really excited.
Yeah. No, it was lovely. The London Business School campus, just on the edge of Regent's Park in central London. It was really nice, well set up. I didn't realize you've obviously been attending in the past, but they have like these monthly things. They're free. They have interesting people. You just sort of pitch up. Obviously, I'm 3 times the age of the average person in there. They're all kind of student, graduate. It's kind of postgraduate thing, isn't it? It's MBAs.
Yeah, the average age in the room was about
mid-20s,
30, 35.
Yeah. Obviously, we made ourselves known, sitting at the front, asking all the questions.
I asked the first question straight off the bat. He didn't really answer it. I said, who are the top 3 business leaders that you've interviewed and why? He just completely avoided the question. I then said, my second part of the question was, what are the 3 best business models you've seen in your illustrious career? He basically just said consumer good luxury companies that got high profit margins that people need, day in, day out. Anyway, so sort of along the line of Terry Smith type stuff. But great night.
Yeah, it was a great night. I obviously had to ask him the controversial question.
But he again avoided.
Hold your, put your fingers in your ears, Carl. I said, what do you think about Bitcoin? And again, he said, well, we don't invest in it at all. But he did say, interesting, he said, I find it personally very interesting, but I just don't understand it. So that was it. And
good man. It's not just me. Christ for that.
Look at him. He's like running a couple of $1 trillion and he just doesn't understand.
Well, I think another bright man might be giving his view on Bitcoin later on when Carl does one of his topical tidbits, or not, perhaps.
Great. So, forward to that. No, it was a great.
Are we just going to call him Crypto Carl now? Is that his new name?
Yes.
CC. You can lump me in with that. You can lump me in with that as well.
Yeah.
Crypto Nick doesn't have the
same ring. But it was funny towards the end because we did went up and had to speak to him at the end, and Andy was angling. He was literally saying, "Do you want to come for dinner?" As if he didn't have something else to do. Do you want to go get?
It's like you assume everyone's asked him out for dinner, but nobody has, and he's like desperate for someone to say, "Look, you're at loose end and go for a Chinese round the corner."
He politely declined.
He's like, "Yeah, that's a great idea, Andy."
Let's go and talk about Metis Norway.
Okay.
Anyway, moving on.
All right. All right. Thank you for that. Me next. Very quick one, really. We get more and more of these coming through on the various social platforms. Most of them, I think, come through via LinkedIn. But this is a post put on LinkedIn last week by a chap called Tom Brooks, who's just launched his own firm called Arboretum. Andy, that's a Latin word meaning a botanical.
I was going to say, thank God you pronounced that. You had to research that, didn't you?
No.
I thought it was Arboretum.
He's launched his firm, and on LinkedIn he said, what kind of fool, what kind of absolute masochist launches a financial planning company 1 month before tax year end? This one. I'm officially launching my firm. This has been a long time coming for me, but I have to give a special thanks to Alan Smith, Nick Lincoln, Carl Widger, and Andy Hart, as listening to their words of wisdom gave me the kick up the backside to get this dream into fruition. And he goes on a bit longer. And I just said at the time that one lovely post to read. It's okay. It's a bit vainglorious against another really sort of glowing review, but I said we give him a shout out on episode 66, Execute Order 66, episode 66, and we are doing it there, Tom. So we wish you all the best and well done for making that leap. You will not regret it.
Clap sound. Well done him.
Well done him
taking the lead
with your hands, Andy, if you can do that and talk at the same time. There's a good boy. All right, on to the next point. Voice.
This is all a bit testy. What's the next point? I'm just literally after arriving back. So Gerard O'Reilly is on a bit of a tour of Ireland. He is the co-CEO and co-CIO of Dimensional Fund Advisors, who manage nearly $800 billion of assets.
Not as much as Nikolai, but that's all right.
Yeah.
And he's the same views as Nikolai about Bitcoin, by the way. But anyway, he was so kind to talk at an event for some of our clients in Dublin. And later in the week, I think the day after this podcast is launched, he's going to talk to some of our clients in Limerick. Amazingly, he's from Waterford in a little corner of Ireland. He's long gone from Waterford, but we're kind of very proud of him because the boy done good and all that kind of stuff. But he's, you know what? He's just a really, really nice guy. Clearly, you don't get to the top of an organization like that without being super slick. Just so eloquent, I would say, in everything that he says. So I took a little short video of him answering a question from the audience, from our clients, about Bitcoin. So I think it's 3.5 minutes. I put it up on LinkedIn, and it's everything I wanted to say about Bitcoin, but it's well researched. It's eloquent. It's there's no bad language in it. It's just a very reasonable argument as to why, for now, for him, it shouldn't be in an investment portfolio. So there you go. You've got Nikolai Tangen managing how many billions?
Trillions.
2 trillions.
Trillions, and add on Dimensional's 800 billion. Clever guys.
Yep.
All right.
I'm
not a Bitcoin shrill, but if you want to play that game, Larry Fink, who manages 10 trillion, it says everyone should have 2% allocation to Bitcoin.
Yeah.
Saying.
Follow the money. Follow the money.
Guy
The same Larry Fink who 5 years ago was saying ESG is the best thing since sliced bread, then bailed out with the wind turn.
That's yesterday's news.
That's the money's stolen from it. There's no money.
You're allowed to
change
your mind. You're allowed to
change your mind. That's a fair point. And it's a very fair point, right? I would say Nikolai Tangen and Gerard O'Reilly have both allowed themselves to change their mind, because they're kind of going, the technology could drive this on. This could form part of a proper financial portfolio going forward, just not right now. My problem with the likes of Larry Fink, or others, I won't go there again, right? But is that they totally and utterly dismissed it in the past. And now, because this can make me a load of money, I'm going to decide that I'm actually going to go into it. And I don't think they're reasonable.
How do you know that? Maybe he's researched it, had a whole research team come out, analyze it, and say, do you know what? There is something in this.
I don't have the quote that I did I read the quote in the last episode or the previous episode from Larry Fink as to what he said about Bitcoin.
What? Yeah, a few years ago, he said it was
totally and utterly
Ponzi.
Yeah, a little bit like the president of the United States said it's thin air, but now all of Jesus, we can make a shitload of money on that. Anyway, I promised myself I wouldn't talk about Bitcoin.
Come on, crypto Carl.
But anyway, have a look. Genuinely, I put a link in the show notes to the video. I put it up on my LinkedIn, so you'll have to click on my LinkedIn to watch the video. But if you like me, you don't believe they should be in cryptocurrency shouldn't be in investment portfolios, and you want a very logical argument as to why, there's 3.5 minutes of perfection for you to show your clients.
Brilliant. Well, I will definitely watch
very good. He's very, very, very impressive, Gerard.
He's just a really nice guy,
and
he's a lot of fun. And I can't tell you how appreciative we are that he is doing
all right,
both
Carl.
of these. No, and a big shout out,
sucking up.
A big shout out to Paul Cat Campfield, who organised all this in Dimensional. So thank you guys.
We like Paul.
Yeah, we like Paul. Good guy.
Okay, moving quickly on. And the next 2 points are around the same brand. So Ultra, you lead off, and Storyteller, you finish with a succinct story.
Sure. Okay, so this is St James's Place. St James's Place come out with their full year results for 2024. A detailed PDF, 80 pages. I read it pretty much every year. Scroll through it. I'll give you some highlights now. I read the book so you don't have to, as I say to my clients. So 190 billion is the current AUM number that they're looking after.
Make it stop.
The split between investment bonds, pensions, and other pensions is now sitting at 53%. Just to get a marker as a gauge, what your individual firm's doing. Their funds under management have pretty much doubled in about 6.5 years. That's obviously contributions going in, markets being kind. There's 73% asset allocation into global equities, managing close to 200 billion. So them as a firm on average is looking after 73% is in global equities, which I think is also quite interesting. Their insurance revenue is quite small compared to their overall revenue. Their insurance revenue is 25 million in terms of their insurance and protection stuff that they're selling. There's various other parts to it. Over to you, Alan, to mention some of your highlights. But it's definitely worth a scroll through for if you're in this space. They obviously account for about 20-25% of the financial advisor workforce. I do quite a lot of stuff with them. But anyway, over to you, Alan. Go.
Yeah, I did. I browsed through it. I was quite interested in one of the sets of numbers that they put out. The numbers are huge, right? 190 billion and inflows and all the rest of it.
Yeah.
But I think you should spend a moment looking at gross inflows, 18.4 billion. 20% increase from 15.4 billion to 20, massive 18 billion money. However, outflows 14 billion, up from 10 billion previous year. So net inflows 4 billion. On the best part of 200 billion of assets, that's only about 2% growth in terms of assets. So they're still out there winning new business, AUM. They're very much a new business company, for sure. That's from all I hear, all the feedback. But they are losing a lot of assets. Now, I don't think they're unique in that. I think that's point number one, is that they're basically grown by 2%, which is much less than market, much less than a firm like us. Obviously, it's not the same, but it is, once you factor the money going out the door from whatever sources. Yes, Andy, what do you want to
Yeah, sorry, the money going out the door, which is what it will be either them switching firms or the age demographic of the clients, as in withdrawing it to spend it for lifestyle, as in drawdown.
Okay. So
I know you're aware of that.
That's what leads me on to the second point. So it's not disclosed how they're losing money. It might be dissatisfied clients. It might be advisors leaving and going independent. We know there's a number of those. But I think a big part of it, because I don't think they're unique in this, is lifestyle thing. It's an aging client bank. Is a cost of living crisis. It's people with a bit of money who are the traditional, advisor demographic and clients, helping their kids, helping their grandkids, cost of living gone up, mortgages, etc. And I just want to bring it on. I don't want to spend too long on this. It's probably a huge subject for another time, but I've certainly spoken to a number of other, pretty sizable IFA type firms who are very, very aware of this. And it's predominantly, no clients are leaving them, but a lot of assets are leaving, a significant amount of assets, to the extent that they're having to work really, really hard to almost like stay the same. If AUM is your model, is that metric, the thing that you sort of focus on, then if you're losing, 10-15% of AUM every year, just because the whole point is you've been telling your clients for years, it's all about lifestyle, it's all about spend and enjoy, and they are doing that, and they're also helping other members of their family. Well, it doesn't half impact things unless you've got a lot of new business coming in. Look at that. Even with all their numbers, the AUM increased 2%, less than the market, significantly less than the market. So they've actually net lost in terms of assets. And so, as I say, this is not unique to SJP. And there's a few firms talking about how they're going to manage this. We're now in a sort of, a pretty challenging and choppy investment market. There's a whole thing about, I'm not going to get down the route about AUM fees, but firms are losing revenue fees as a result of clients' choices about withdrawing assets.
It's definitely not the case. It's definitely not the case in Ireland, but definitely would have been the case back around the financial crisis. So I think it's more cost of living than anything else. Maybe in the UK, and it's the UK struggling, and maybe there's a lot of the older clients are wanting to take money out and put it in the bank, and maybe because there's a fear of what is to come, and that's a cycle.
Why is Ireland exempt from just lifestyle, aging clients spending money, drawing down,
giving money to kids, paying off mortgages because interest rates are high, paying off buy-to-lets?
Yes, Carl.
Stuff.
Why?
Yes, Carl.
Yeah, I think it is for an extended.
Okay, am I going to answer the question, or seeing as three of you asked the question, so just hold tough and I'll answer the question. I think number one, we do not have high mortgage rates here because we're in the EU.
This is red meat to Nick.
If you listen to what I said first time around, I think back around the financial crisis, I think Ireland would have suffered more than everybody, I would say, because we had so much debt in the country.
The Celtic Tiger.
So I think financial planning firms, although there was very few what we would know as financial planning firms, but I think financial advisory firms, generally speaking, majorly struggled because people had to whip money out, and they were also afraid. So there was this fear factor because they're listening to the news that things are terrible and they're going to be terrible for a while. So I think people took it out of investment portfolios and maybe put it into the bank. So I don't think Ireland is immune to people getting older, but I think maybe that it's a kind of, maybe it's a barometer of how an economy is going. And I'm not saying that Ireland is immune to this and will be immune to it. We're in a really sweet spot right now. I'm not an Egypt. This is going to, this is a cycle. We will, in time, there will be a struggle. So I don't know. Certainly nobody I'm talking to is losing lots and lots of assets. And maybe I'm just talking to a particular subset of people who are doing really well. I doubt it, though.
Go on, Nick.
I think the conditions we're going through currently we'll address in the meat and potatoes coming up later in episode 66. But obviously things are a bit choppy, and we know of big firms that are just about making a profit now. It's bizarre somehow. I don't know how. In the back of 15 years of just an amazing bull market, more or less. So it's going to be interesting if these choppy conditions continue for a protracted period of time. And on the fees thing, it's self-serving to a degree. But I do think it makes sense to have a model where your fees as a percentage, if you're doing a percentage model, are tiered. So at least you've got some insulation if clients are spending down, and it doesn't bother me when clients spend down at all, because it's the right thing to do is to get clients to spend money, and I've still got a significant amount of AUM that's going to be fine for me. But even if they are, from a purely financial point of view, as they drain down, my fee as a percentage goes up. Now, of course, it doesn't make up the difference, but it does just help. It's fair going in and fair going out. But it's never crossed my mind as a problem when people want to spend. It's crossed my mind when people say, I don't want to work with you anymore, but that never happens because if I sense the conversation's going that way, I put the phone down, as we all do. It's easy.
We can definitely unpack it in a bit more detail at a later point.
Okay,
yeah, good point.
It's an interesting discussion.
It is,
sure.
And I think you're right. There's particularly the bigger firms. Did we talk about this before? But I remember seeing something only a few months ago, and it talks about profitability and in the UK per number of advisors. And the most profitable firms were, well, first of all, the sole trader firms. They had very little overhead. There was a decent sweet spot at the kind of mid tier. But anyone with like 25 advisors plus, they were making little or no profit, and that is on the current model. So you get that double whammy of people taking money out for lifestyle costs plus a depressed market for a period of time. They're going to be running at significant losses, no question about it. And so we'll see. The next few months are going to be quite interesting in that whole dynamic. But onwards.
Okay, let's keep it punchy, keep the pace going. At 28 minutes in, who's next? Oh, crikey. Okay, Ultra. Come on.
This is another annual letter, another one of my people that I follow.
What did you do? Did you read the SGP results, like chapter 1, then read the first 3 hours of the Berkshire Hathaway letter, then back to chapter 2 of the SGP results? What did you mix it up?
That's uncanny, Nick. This is exactly what I did. Yeah, fantastic. So this is Warren Buffett does a letter every year to the Berkshire Hathaway, just about. He's sort of writing the letter as in, this is probably my last letter, but he's probably going to do that for many years. Greg Abel is going to take over, who's going to be the new CEO of Berkshire Hathaway. So it came out on the 22nd of February. It's only 15 pages. It's pure wisdom. He is a wordsmith, and he's someone that you should be interested in what he says if you're into finances and business, but that's up to you. He mentions about paying the biggest corporation tax payment in history, and he's delighted to pay it. America has given him everything. He's had huge tailwinds with American business, and he wants to write bigger and bigger checks as time goes on. So yeah, it's definitely worth checking out. He also mentions quite a lot about the insurance business and about float and various other things. So he's basically paid an enormous corporation tax bill because he sold a huge chunk of Apple stock. I think he owned about 150 billion of Apple stock at one point, sold a big chunk of it and paid a shed-load amount of tax. Has he got that decision right? Who knows? But yeah, link in the show notes. Definitely worth taking a read through.
He's looking quite good right now, isn't he? I think he sold Apple stock almost at the peak.
Yeah.
Ish.
Time will tell. Time will
Sitting
tell.
in a huge cash pile.
This too shall pass. onwards to you, Nicholas.
Okie dokie, just a very quick one. It's like kicking a cripple, really, but we've got to talk about it. The whole Aberdeen rebrand disaster. I mean, there are levels and there are levels of these kind of things. We knew when it happened, 4 years ago, that this was just nuts. And of course, Aberdeen have now gone to be back to calling themselves.
They've just
Aberdeen.
put the ease back in.
They put the ease back in. They put the ease back into financial services. Ecstasy once again flows through Edinburgh. What a cock.
Nothing good happens when you drop a few E's.
When you drop a few E's, yeah. Lunatics. There's a link in the show notes to an article. The chief exec, Mr. Jason Windsor, was asked.
Windsor.
How much money was spent on this rebrand back to Aberdeen with the vowels?
Nothing.
And he said, straight faced, apparently, we've not spent any money on it at all. We've done it all internally. You put the vowels back into your name. Well done. This is the same firm whose finance officer a couple of years ago said that it was corporate bullying, the way people were taking the piss out of the Aberdeen name. And if it was a person, it wouldn't be acceptable. But because we're a company, it is. Yes, it is. You complete knobbers. Right, moving on.
They never recovered from me leaving and taking my wheelbarrow.
You're not getting a drop. We're saving that to the live show. You're not getting it. You're not getting it. We're not going to shoehorn that in. Okay, next thing on this.
Shoehorn?
Shoehorn. Thank you. The next thing on this is...
Carlos.
PRSA. Is this some sort of prostate test?
Oh, the good old PRSA. I can't wait.
For the Irish listeners, the boys are slagging me all the time.
For the Irish listener.
Talking about PRSAs all the time. I wanted to put this one in because Royal London, up until a couple of years ago, only were protection providers in Ireland. And they went into the investment and pension market. And early doors on Trap, I gave him a bit of a slagging off because I said, here's a new entrant to the market with a lot of history behind them, and they had an opportunity to do things right and not have all these massive high commission models.
It's on the fees, yeah, I remember it, yeah.
Well, they brought out a new PRSA, which is the way our pension markets is going. Have I mentioned that before? Yeah. They're bloody brilliant. They're really good. They're really low cost. They've index fund options. They're absolutely outstanding. And the service levels have been brilliant. Can they keep that going when people start flooding PRSA business to them? Let's hope that they can. But look, credit where credit is due. Well done, Royal London. Yes.
Great advertisement for Royal London Ireland.
I don't see your finger up. Your finger's not up. Thank you.
Oh.
Right. I mean, in this country, and then it's Ultra, by the way, Alan. In this country... Royal London have got a very good reputation, I think, as one of the sort of non-platform traditional life assurance pension providers. So it's good to know that they're doing well in your neck of the woods. Ultra, and then you, Alan.
Yeah, good point, Nick. I could be wrong on the numbers, but I think they're looking after close to 180 billion and growing aggressively. Carl, out of interest, what specifically has been their innovation that you're thinking is pretty cool? Like anything to note?
So I would say fees, right? So everyone was telling us that PRSAs, all the providers are going, there's a lot of regulation behind this, or the fees have to be, high. And sorry about that, but it just is what it is. And then they come in and went, no, we can do it at very low, at kind of 20, 22 basis points, and then add on your a very low cost index fund. There you go, and add in your trail fees on top. As opposed to people going, oh no, they're very dear. Sorry about that. So competition's great.
So have they got proprietary tech? The tech's good as well as the fees are low?
No, and look, it is going away a little bit from doing your business on a platform, but at the same time, if doing PRSA business on a platform is too expensive, well then you're going to have to talk to your clients about perhaps looking elsewhere. So watch this space. I think the other providers will react. If they don't, they should. And they will eventually, but maybe it might be too late.
Storyteller.
No, it was just a facetious comment. It was a great product placement advertisement. We look forward to the check from Royal London, Ireland, in terms of
PRSA Corner.
This podcast comes to you from Royal London,
PRSA Corner.
Prozac.
Prozac.
Yeah. Okay, let's come on. We're 34 minutes. Let's crack on through this. Thank you for that, Carl. I just read this piece, blog, the FIRE movement, the financial independence, retire early. This is a blog called Fire versus London. This is a young guy who lives in London, obviously the most expensive part of the UK, and he's managed to do this FIRE thing, and he puts out a blog, and his blog was on the death of in his view, buy to let. Like all the FIRE people that I've experienced, extremely numerate, knows the numbers inside and out, has looked at this from every angle he possibly can, and he's just recently given up a buy-to-let flat he's held for years and years and years. I just cannot make this work anymore. So just really interesting. It's a nice flat in central London, and he's walking away from it, and it's just too much hassle, too much tax and everything else. So I think just interesting to see that the really switch on people, as well as just maybe not being pejorative, but just Mr. and Mrs. amateur landlord who are exiting en masse. But the really numerate guys and girls are looking at this and saying, no, this is not for me anymore, getting out. So
you said that, Ron. It is a good article, lots of accurate data in it, and I think it just represents, it's just a shifting. Things evolve, things change. The tax laws change, the whole setup. It was attractive 10 years ago. It's become less and less, and someone like him is just saying it just doesn't work. Andy?
I'd say it was attractive way longer ago than that, like 20, 30 years ago. And we've exited the golden age of the
buy-to-let
property investment. So years ago, Mr. and Mrs. running a company paid minimum amount of tax, drew out some money, had enough deposit to buy one semi-detached house. The rent was great, etc. So we have overcorrected. It used to be just too easy to make money in property. You just needed to buy one. And now we've overcorrected and made it insanely high hassle, insanely high legislation, and insanely high taxes. Not that anyone knows the answer to this, but where will there be a movement back to it becoming more viable? Is it just we're just going to have to see how time pans out?
It's an imponderable.
Okay.
Yeah.
Will they release the tax back? Will they make it more attractive? Will they reduce stamp duty? Okay, it's just an interesting, because we have to watch this space. We're in this space. We deal with this space with clients.
The underlying issues about housing, isn't it? We do have a shortage of housing in the UK, and so whether the demographics are changing, they're evolving, don't want to go down that political route too much. People will always need a roof over their head, bottom line. But it's been attacked by successive governments from a tax viewpoint. So you're net after all taxes.
I think it would have to swing back the other way, but you're right. Who knows when?
Things do eventually do swing. Everything's in a cycle.
Cool. Okay. Hopefully I'm not missing anybody out. So look at the next thing on here. Storyteller VCTs.
Yeah, look, this is a quick one. This was an article which was in the Financial Times last weekend, was it, or the weekend before? I just thought it very interesting. I like reading these things which are quoting facts and data. It talked about, I think the story is venture capital trusts, VCTs, which have just passed their 30th anniversary. They've been in play for 3 decades now. So it's an opportunity to look back at how people have done if they've had invested in them. For those who don't know, it's a significant tax break on this type of investment, but you're investing in venture companies, small companies, startups, that sort of thing. So certainly high risk, high volatility, albeit coming with a very helpful tax break. I think I'm right in saying that the UK advisors on this podcast, other than me, Ultra Lick, aren't fans of this, never really got behind it. I mean, a lot of advisors I know, we speak to, we're in a meeting this morning, Andy, a lot of them love, people do really like, a lot of advisors do really like this as a product. But interesting, just quoting the actual data, and obviously you can cherry pick time a little bit, but the Financial Times quotes that in the total average share price total return of VCTs of the last 5 years is 7.7% total. And over the past 3 years, investors have experienced a 16.1% loss. If you put your money into a simple FTSE index fund, and FTSE hasn't exactly been, the sort of runaway performer of the last 5 years.
Not been too bad.
You'd have done 36% or 43%, including dividends, and 19.4% over the last 3 years versus a 16% loss. Point being, this is the classic tax tail investment dog, all the rest of it. There are, 30% income tax relief, very attractive, tax-free dividends, get your money out tax-free, etc. But just be careful, the underlying investment, the returns historically have been, according to this report, very, very lackluster. Had you just put your money into the normal public markets with no tax break, you'd have been far better off. That's it. Any thoughts on that?
No,
Ultra?
broadly agree.
No, you've nailed it.
Broadly, and VCTs are the sort of plain vanilla end of this, aren't they? You've got things like EISs and all these other things, which
exactly.
ratchet it up another level. It gives me the screaming abjabs to a degree. Okay, it's moi next. This is an interesting. Well, maybe you don't find it interesting. I find it vaguely interesting. On the IFA forum, tiny.cc/IFA forum, there's a little thing going on about annuity rates. Apparently, you can go on as an IFA if you go onto these like a SureWeb or whatever it's called, iPipeline, and just do an open market annuity quote for a client. And it brings back all the providers, bing, 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 bing. But you can go to these firms, including Hargreaves Lansdown, but another one called Retirement Line, where they look to be getting preferential rates from the annuity providers. And even if you rebate all your commission, because it's still commish effectively, although they call it a fee now.
Fee.
But it's whatever. If you rebate your fee/commission, you cannot match the rates offered by these brokerage companies, which offer no advice. And it's a throwback. So it's an old RDR quote that if you're broking products for clients who say, I want this client, commission can still be, it's just old school kind of stuff. And you're getting these dual pricing things, which used to be all the rage 15, 20 years ago. And it's always a pain in the arse. And it's just an example that, this is the sort of Don Corleone thing. The more I try and leave this thing, the more I'm sucked into it. Just when you think this kind of thing has gone away, I mean, I haven't done an annuity for a long time. I do have to be more cognizant of annuity rates now because they're not quite as shit as they have been for 20 years. So apparently I've got to look at them. So I do look at them, but I still don't write them. But if I did, imagine doing all the research, through the advised channel, and the client says, well, I've been to Retirement Line. And the difference is that the same providers that are offering on these brokering platforms are significantly better than what you can get on a nil fee basis through the sort of the AssureWeb annuity comparison things. It's just like, oh God.
It's like institutional pricing, isn't it? They must be doing just tons and tons.
Yeah, they're doing tons of biz.
They're getting enhanced
tons of non-advised biz.
Yeah, Hargreaves have had preferential rates for as long as I can remember. And you're right, Nick, it's a substantial difference. You'd feel pretty bad doing an annuity, let's say, keep it simple, for a client, 10 grand a year, and they can get £13,000 a year elsewhere. That compounded over
it's such a big decision,
many years. It's enormous. So I think some advisors are charging a fee to provide the advice and then saying, well, actually, you're better off just filling out the paperwork there rather than here.
Yeah, our friend of the show, Justin King, has said that on the forum.
It is something else to consider in this hyper-complex space that we work in.
Indeed. How does the annuity market work at your end, Carl? Is there one pricing model across the board?
I have no idea.
Carl, wake up.
Carl, I don't know.
If it's not PRSA, he's not interested.
I don't know if we've done an annuity in the last 5 years, honestly.
Okay, fair enough. That's a fair comment. Not dissimilar to my experience. Okay, there we go. Anyway, just a throwback to the good old days. All right, Wodge. Household wealth in your neck of the woods.
Yeah, this is a central bank report, which I think every financial planner, advisor, wealth manager should read. We've never had it so good. It's unreal. The really encouraging thing out of this is that whilst the household wealth is skyrocketing, and we have had it never so good, the debt to asset ratio is
declining
because but not as a result of assets increasing. It's because I'm making a bags of this, right? Let me start again. Basically, back in the financial crisis, we had an absolute we shit ton of wealth and a shit ton of debt. And then when the wealth all dropped, it was like, oh, we have a big problem here, right? Now the money is all going into deposit-based instruments, so it's not going into growth instruments as we would know them, and yet we're finding that the debt to asset ratio is falling, which is really, really good, because it puts us, when this cycle does turn, and it will turn, and we all know that, it puts us in a really good position that we have as a nation learned from the sins of the past. The other big thing that came out of this for me, and you always make the point that we are in a premium type of market, right? The top 10% hold 49% of the wealth in Ireland. I guess that's probably the same worldwide. That's the market we operate in. So for us, we've never had it better. So there's so many people who need so much advice, so much good advice, and so many people are leaving money behind, not creating wealth for themselves by just sticking money on deposit.
Yeah.
So, and they'll also see that I was deeply uncomfortable with the content of some of today's podcast, owing to the Irish versus UK cultural differences.
Carl, you haven't talked rugby this week. Why is that?
What's that?
You always talk rugby.
Oh yeah, we forgot about the rugby.
What?
Are you stopping for the Grand Slam, Carl?
No, unfortunately not. We're not. No.
What position are you in the table? What position are you guys in the table? It goes France, then it goes
we'll see.
England.
I'm not sure how it goes, but we have to play Italy anyway. In the last game,
you know what the tragedy is? I mean, Scotland have had they've played well. We've been unlucky, and we've played France.
This is Scotland every single year.
No, I know.
We are so
5 more minutes,
good.
you'd have lost to Wales.
No, we wouldn't. I mean, don't you just you?
There's a chance Scotland could beat France.
There's a chance that Scotland would beat France, but the tragedy
in Paris,
would be, if that happens, there's a good chance that England would then win the whole thing.
Yeah, come on, Scotland. Come on,
There's
Scotland.
no chance. There's no chance.
Scotland
They're going to
beating
get
France?
pummeled.
No, I don't.
Who are
think
England
so.
playing?
Wales.
Then,
Wales.
is it?
Yeah.
I know Wales.
In Wales.
Yeah.
Wales have more chance of beating us than you got of beating France, my friend. We'll see.
We'll see.
We'll see.
Okay, right. Anyway, so last 2 topical tidbits, and that's just a point of record, really topical tidbit. Putting a timestamp on this sad story, ongoing story. A few years ago, IFA Kerry Nelson was charged with fraud of embezzling client funds. Previously, one of the more high-profile IFAs in the Portsmouth area in the southeast on the coast in this country. Very prominent person. One of these people that won Business Lady of the Year, blah blah blah, and this, blah blah blah, that, blah 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 blah, and then this is going on. Had a court appearance recently and pled not guilty, which is an interesting line to take because prima facie it doesn't look like she's not guilty at all. So that's got ramifications for her, and I hope she's getting all the best legal advice she can get. But just an update on that. And wow, the only thing you have in this world is your reputation, really. And once that's gone, Alan, as you know, it's gone.
I was going to say, pot kettle, Jesus Christ, look in the mirror.
Yeah. Imagine Lick Ninkin saying that. But you didn't have a reputation to start with, though.
So there you go. Just trying to right now. Just trying to
have a reputation to lose.
Just trying to have a little fun.
Look, to be fair, these things don't happen very often. Something like this. This wasn't some weird like Cayman Island hedge fund or some weird shit that you hear from time to time. She was like proper, IFA. I don't think I've ever met her, but I certainly saw her. Yeah, as you say, she won a lot of awards. Like that's the other thing, IFA of the Year and Women IFA of the Year. So who the hell knows? But it's kind of like it's in our sort of area, isn't it? She's a more regular IFA, and yet she's who knows? It's all alleged, and she's pled not guilty. So I guess there's a court date, and the whole thing will unravel. But the point here is it's so unusual. We've got a very highly regulated marketplace. So.
Thank God. So unusual.
Yeah. Okay. It's just bad all round. Everyone involved. And the final point. This ties into what Ultra led off with on the topical tidbits. But storytelling.
Yeah, just a quick shout out for our friend and sort of fan and supporter of the podcast, Samantha Russell, who has co-hosted as well in the summer in the past. And he did mention at the top. Sam will be presenting and will be sharing some of her wisdom and ideas at Trap Live. So another reason to come along. Sam, interesting, obviously, is a specialist in marketing for financial services and financial planning. Is American, lives in America, but she's relocating, at least for a period of time, to the UK and basing herself in London from the sort of spring onwards. Hence, she's got time. She's speaking at a few events. She is, as I say, at Trap Live. But she's also launching a series of marketing workshops where she's going to sort of really get into the weeds, limited number of people, roll your sleeves up and literally build a marketing strategy and a marketing plan for individual advice firms. So I'm going to put a link to this just to register your interest in this particular project that she is launching in the summer in London. So well worth checking out because she really knows her stuff when it comes to marketing.
Yeah, she does. I think all three of us saw her speak at the IFP conference last year in Manchester.
Yep.
CISI, but yeah.
And she's sorry, there's a throwback. CISI. She definitely knows what she's talking about. Okay, crikey. 50 minutes in, we better draw a line under the topical tidbits and move on to what many people call the meat and potatoes of episode 66. And it's both evergreen and it's both prescient. That means of the moment, Andrew.
Thank you.
Annual declines. We're going through a moment now where, for whatever reason, people are saying, the markets are choppy because of tariffs. Nobody knows really what drives markets. The fact we've had 5 years of really good returns just means maybe some froth is evaporating. Sometimes it just happens for whatever reason. But it's definitely happening. It's been quite a strong month, if you like, volatility of the downward sort across the world, but especially in the US. And again, not perhaps the most unexpected thing in the world. But how are we reacting to it? How are we handling it? This is where we earn our corn. We're all four of us here in the Trap Pack proclaim ourselves to be behavioural counsellors, helping clients, devise a plan, and then more importantly, because that's the easy part, any idiot can devise a plan, us four do it. It's getting clients to stick to the plan. That's where we earn our corn. How are we doing it? How do we do it from the outset when things are good? How do we do it when things are less good, as they are now? Already we're seeing the mainstream media do its panic bit. I can't remember who it was. Was it you, Storyteller? You put a tweet out in the last couple of days about a guy's launched an emergency podcast because the S&P is down.
It's a big podcast. Merrin, Somerset Webb, John Stepeck. It's a big finance
Somerset
podcast.
Webb is really savvy, but it's just
smart. But it just
wait till we have the full normally and totally expected temporary decline of 30 to 40%, which is long overdue. Then God knows what they'll be doing. Their podcast every minute. So we're going to address that in today's meat and potatoes. How do you prepare clients for the annual, sometimes awful, but perfectly normal, perfectly to be expected annual declines? We haven't talked about this because we're totally disorganized. Who wants to lead off?
I'll chip in a little bit. It is very pressing at the moment. We do run into this usually once a year, as Nick's alluded to. It's usually around minus 15%. That's what it's been for the last 40 years, but every 3 to 5 years expect at least double that. But this is our whole being as behavioural financial advisors. And once you realise you look after people and not just money, it changes how you see things. You can create the perfect financial plan with every single future life event mapped out, anything requiring time, money, planning, the most optimal portfolio. And the first sign of a storm, the client wants to blow the plan up. You've failed as an advisor, in my opinion, if that happens. So it is a very important thing. I did back to, I think Nick's going to allude to it, client communications. This is what this falls into. So I do a monthly newsletter. My latest one was entitled 2 Good Years, What Comes Next? There was a big tick in the box of 2023 is in a good year, but big tick in the box of 2024, 2025. Who knows what's around the corner. And I'm in my sort of annual planning meetings with my clients, financial MOTs. And again, I'm saying that to them. We've had 2 good years. You don't take credit when the markets, fly. And you also, in some ways, don't take credit when the market decides to have a deep temporary decline.
Don't thank me when the markets go up and don't rip my head off when they go down.
Basically, yes. You'll get the returns of the markets long term where they've been amazing. The risk in the stock market is not being in it. So this is a constant message framing with clients. We are the last line of defense. They're going to hear just complete, BS out there. And as Nick Murray says, the human body cannot retain vitamin C. It cannot retain investing wisdom. So we have to continually bang the drum loudly or quietly, depending on the client's disposition. But you want to have long-term focused, calm clients. Then you've got a long-term focused, calm business, which means you've got a long-term, calm, focused life. They go hand in hand. If you're constantly picking up phone calls and frantic emails from clients, you're just going to be spinning around. So, it's a huge, huge thing that we deal with all the time, and we are on the front line. We are not just financial commentators. We are not, radio hosts. We look, real people in the eyes, and we look after their, family's life savings. So it's a very, very important thing that we got to straddle. Who's next?
I'll let me, Carl. You seem quite reticent. Oh, it's because Ireland's booming. They're immune from this. For the rest of us.
Oh, just some numbers on it. The S&P from a high point, which is the sort of main market I look after, is minus 10%. I welcome these declines. As I say, they come around as often as your birthday. We say to clients, as in once a year. And when the market declines, it's when the good advisors stand tall. So yeah, I'm all good with it. And obviously, if you're contributing every single month, you're buying at a sale. So you want to hope your money goes in. That's how you get the better long-term return. So yeah, I've said enough. Nick,
just to give Storyteller 45 more minutes to prepare some sort of answer when he comes to him.
I'm ready.
What do you actually do with clients?
Sorry, is that a question, Nick? What do you mean?
What do you actually do with clients? How to prepare clients before, during, and after annual declines. That's what's in the meat and potatoes.
Okay, we're getting onto it.
We're some time to think about it, Andy.
We're just starting the dialogue. It's what we do every single day, every single interaction. How we tee them up, how we take them on, how we have meetings, how we talk about investments, how we show them the returns, how we,
look.
It's our being.
You're very good, Andy, at data points. Intra-year declines 15%, market assist, the S&P 10%, but it's data, and
no, I get that.
It's just it's different. So a couple of points on that. And I know that's quoted. That originally comes from the JP Morgan
Guide to the Markets. Yeah,
intra-year declines. I think 15 or even 16%. I've seen.
It used to be 14.8. Now it's 15.
And so I think intuitively, I don't feel like there's the S&Ps, you say, has gone down 10%. So
from a high.
Much less than the average, and yet the world
Correct.
is on fire,
Yeah,
and people are issuing emergency podcasts and things like that. So that is a stat, but the point is, it very rarely goes from point A to minus 15% in like a few weeks or a month. It sort of goes up a little bit, goes up 3%, goes down 2%. And so
it did it in 2020. It went down minus 35% in less than a month. I know that's an extreme example.
There was something going on then, if you can remember.
Yeah.
But so that's, as much as that is a statement of fact and data. It never feels like markets are going down. It's a bit faster at the moment, really, since the turn of the year. Who's your mate, the American guy who he spoke at Hum, I think, by video link? Frazier, something or other.
Brendan
Fraser. Yeah, that's him. I like what he says, because his is all about, he's always pushing stuff out about, how to communicate with clients. And if people aren't following him, you should follow him. Posts on LinkedIn quite regularly. I think he's got a podcast. But he talks about, the key thing is listen. If clients really are concerned, all about listening to them, all about acknowledging, all about saying, I feel the same way as well. I don't know where this is going to go, as opposed to throwing some bloody charts and data. And don't worry about it. Markets always recover, etc. But we laugh, but I do see that a lot. People immediately go to to their clients. I mean, it's all right amongst all of us. If you're speaking to somebody, I think the big things. It's like any sort of human communication. Let them be heard. Build empathy. Tell me more. What does it make you feel? How else? In my experience, sometimes people will talk themselves out of it if they've had 5 minutes and somebody truly listening to them and asking them, how's it made you feel? What's this? Have you felt this before? Or whatever. A bit of sort of amateur psychology. And eventually, when I remember having a few conversations, said, you know what? Yeah, I'm not that worried about it. But they wanted to verbalize and express a feeling and an opinion. Just a little specific tip, I will say, then I'll shut up. This idea of communicating and what you do with clients, and there's this inevitable, as much as we say highly predictable, highly expected, these are not necessarily from the client's viewpoint, particularly in the back of a bull run. They've got used to seeing the chart going from bottom left to top right. But across the client bank, you've got different people, haven't you? And you've got different types of segments. So we do our best to. I think I see this as 4 corners of a square or a quadrant. Any client that's been with us as a client for years, I mean, years and years and years, they've been through this before. They've been talked down off the ledge. They kind of know what we're going to say if they get in touch with us, and they're used to it. There are clients, and it's arbitrary, whatever you want. I'm going to say less than 3 years, 33 years or less, 36 months or less. they haven't really, and certainly if it's post-COVID in 2020, they haven't really seen much of a significant fall. So that's one level of area to focus on, a relatively new client as opposed to ones that have been there for years. And the other part of that segment is those, if you've done whatever we think about them, but if you've done a risk profiling questionnaire and they've identified, they basically said, I don't like volatility, despite what I understand, I just don't enjoy volatility, whereas others have said, I don't really care, I don't pay attention to it. So that sweet spot is clients who have been with you for a relatively short period of time and they've indicated that they hate volatility. Those are the ones you get on the phone. You don't send them a chart or a graph or don't worry about it. You pick up the phone, just thinking about you. What's going on? Have you paid much attention to this? Most of the other clients, I just wouldn't communicate with. I wouldn't add more noise to it. I'm not talking about like a small, like a less than 10%. I'm talking about a significant market.
I mean, they shouldn't be with you, really, should they?
Yeah, but they've been with you for 6 months.
Relatively on board the bus. Your betting process was
I'm with Alan all the way on this. I'm with Alan all the way on this.
Thank you, Carl.
Yeah. Do you want me to go, Alan?
Yeah, please.
Because I think that's so valid. The people who've been with you for the last few years and they're just seeing their money going up, they do maybe think that Metis Ireland or Capital Asset Management are geniuses. They might just put my money in and it just goes up. Why didn't I meet these guys before, right? So I think the question you asked about, how do you prepare clients, blah, 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 that you prepare clients the minute you meet them, right? That's the answer to that question. And I suppose every time you're doing your Metis Life Plan, your Voyant or your cash flow modeling, whatever you call it, right? That's your time to say a couple of things. Can't you see from the chart that you are a very, very long-term investor? So we'll be kind of talking to you all the time like you're a very, very long-term investor. So therefore, when these temporary market declines happen, they're not going to matter. It's so important you reinforce that message every single time you meet the client. But go back to Alan's point, you have to accept people are there's human beings here. There's emotions involved here. And it's I think dismissing people out of hand is, well, I don't think they'll stay with you very long. I think it's you got to see people where they're at. And I do find that, call a spade. We've seen most of our growth in the last 3 years. So we've a ton of brand new clients to Metis in, and they're thinking everything is rosy in the garden. And now maybe they're kind of going, holy shit, what's happening here? And it's just important for us to, reinforce all the messages that we did. And I think there are a number of opportunities that fall out of this. I think the first one is go and let's have a meeting. Didn't we say that we could have a meeting whenever you want it? We can jump online and we can review your Metis Life Plan and just go back through it and give you a little bit of
same process,
assurance. Maybe, especially with the newer clients, I know, Nick, you hate this idea, but we would have been, and I've said this, I've gone on record saying this, that we would have been okay with some people sitting on cash and not investing everything, and that we'd wait and we'd work through it with them. Now, maybe there's a big opportunity to say, hey, now is a good time to get in. Let's not look a gift horse in the mouth kind of thing.
If they were fearful before, they're
no chance.
Petrified now.
I have proof in the last week or 10 days that that's not the case. Okay,
so someone held back and now they pulled the trigger. Great.
Yeah,
okay.
Yeah. I would also say, if you believe in evidence-based investing, you can feel a little bit smug right now that all the active guys who said they knew what was going to happen and they knew what to do in times like this, they're all real. They're stuck right now, and they're like going,
as ever.
Oh my God.
I know that's the story. Yeah, index funds are all well and good, but markets are going up. But you wait, till markets get choppy. Yeah. We come into our own.
Well, there's a guy isn't there, who's quite loquacious and he's
anti the evidence based investor brigade. I mean, I think he's okay. He's got a point.
He's doubling down, isn't he?
Yeah, he is.
Sorry, Carl.
Yeah, and fair play to him. I think reinforcing the message as well that you told them this would happen.
Yeah,
that's really important because that builds trust. They'll go, oh yeah, they're not actually just bullshitting me and giving me marketing talk here. that they actually did tell me, and they gave me the numbers that, look, this is the maximum drawdown in this kind of a portfolio. So you're building trust to say, not only we this might be a very minor temporary blip, or this might be a 20, 25, 30% temporary market decline. Who knows? We don't know. No, nobody knows. So I think it's you know, I genuinely feel like there's opportunity abounds when something like this happens. And go back to what I said about the central bank. I'm sure it's the same everywhere. There's so much cash being hoarded on deposits, getting crappy returns. There's your opportunity. There's a massive opportunity. And get out there and communicate with your clients, right? The last thing, the very, very last thing you can do, you should do, is, you know, not communicate with your clients.
Which happened massively in the 2007-9 financial crisis, and also I think also in that Wuhan bedwetting month. I think a lot of advisors just went to the pillows, or whatever the phrase is. Went to the. I
don't know about that. I think people were so afraid that they might die back then that they weren't really given much of a crap about their investment portfolios. But
no, but I'm sure I know all four of us were putting out content to our clients even in that month. You know,
absolutely.
You know,
we were, but we were also almost reveling in it at the time. I remember having conversations and going, you know, this is where we will stand up and be counted. And
definitely.
This is where the guys who promised X, Y, and Z, you know, they're going to have to run for the hills here, and we'll be able to go, no, this is okay. And I think that was brilliant for us, because the recovery happened so fast that it was like, yeah, there you go, told you. But yeah, I think this is okay. I know you guys know we hired a CIO, and it's, you know, we are going to be communicating a little bit more on this kind of stuff. That's my call. I know there's people on, probably all three of you think I'm wrong on that, but I just think communication is okay. And
no,
you know, I you know, fronting up, but the prep work for I know there's tons of younger advisors starting out in their journey, because we get messages every single week about this, right? The prep work starts on your first meeting with your client. You start telling them, talking this language. And then, Andy, I loved what you said about, you know, you'll have a calm business, you'll have calm clients. Not everybody is going to be calm in volatile periods, but if you can get most of them calm enough, or reasonably calm, that's going to make your life much, much easier.
And from the off, as you say, you need to tell them the unvarnished truth about the investments as you see it and as you know it. You know, history being our only guides and no facts about the future. Who's next?
We've talked about this in the past, but if anyone hasn't read it or looked it up, look up Nick Murray talking about doing a lifeboat drill. That's what he calls it. You do a lifeboat drill. When you go on a boat, a big liner or whatever, to do it. If in the event of us hitting an iceberg,
is this new content?
It's about
same thing,
50 years old, but nevertheless, it's quality. You don't. It's like saying to Shakespeare, Shakespeare. Any new no? If you create some good stuff, you don't have to. Like,
you can't improve with affection.
I just. Did I mention Gerard O'Reilly spoke at an event for Metis? Well, he actually at this event for Metis.
Talk about PRSAs.
He said these words came out of his mouth. It's time in the market. It's not timing.
So there you go. How's that go? That's good.
Write that down, Nick.
There's time in
WhatsApp it to me.
Got it. Like it. That'll catch on.
But the point is, you set your clients up saying it's not if, it's when. There will be a significant. Just let them know. It's a little bit of an uncomfortable conversation, because you don't love to know that, but just say this will happen inevitably. I just want you to know, in the event of this, we stick to the plan. Just to remind you, and we'll mention it again every time.
And if you want to know how people are going to react, say to them, instead of going, and the market, could drop by 25%. Say, the £1 million you're giving me. If I come back to you,
show them in a plan.
The value is 750 grand. Is that going to be okay?
Can I just close up on this, because you're taking all the points I was going to quickly talk about, if that's okay, as I've not spoken to any great degree on this yet. So coming back to Wodge's point there, that is an absolutely key thing, and this whole thing is about vetting who comes on board your bus and then keeping them on board the bus through the bad times. But you've got to get the retaliation in early in this conversation. You've got to be having these conversations about what's going to go tits up before they go tits up, and things are okay. Sorry for the language from that lady who's got kids in the car. Throw them out the car, do a U-turn, pick them back in the car, scrape them off the tarmac. And it's that point of making it personal to those particular prospects and or clients. So don't use market figures because that's nothing to Mr. and Mrs. Prospect. As Carl was alluding to, if you've got a client, husband and wife, couple, and they've got £1 million retirement fund and they're trusting you with it for the next 30 to 40 years, you say, okay, it's very likely, I can't guarantee might happen, it might happen in more extreme form, but it's very likely that over the next 3 to 4 decades, your pot of money will fall in value by at least 30%, maybe 2 or 3 times. That means your £1 million could be down to £600,000 when you log on to get a valuation. How would that make you feel, do you think? I know it's a really difficult question to answer because you're not, but I want you to, how would you feel? So put it in terms that they understand. Don't say the market's down by 40% because they go, well, what's that got to do with me? Well, it means your £1 million is £600,000. And talk to them. Don't blind them with graphs. I mean, I use one graph. It's a graph, a time graph, straight line. Here, 30 years time, there's your pot of money, there's the financial plan. It will be fine. The line goes up, but the thing is, that journey is like a seesaw along the way, up and down, up and down, up and down. And in those down points, you're going to want to kill me, all right? And my job is to keep you strapped in to your investment portfolio that funds your plan. The only way you're going to get to financial success is by sitting through those down times, okay? If you don't think you can do that, then we're not going to work together. But you're saying this as the S&P is going up 25% one year, 14 the next, and they're going, yeah, whatever. But you've got to try and get some buy-in from them. Reiterate the point in all your communicate. Everything you do should be about this. I mean, I do this hat tip essay every month because it just helps me organise whatever thoughts are left in this scattered brain of mine. But in every hat tip essay, I'm subtly, in some ways and other ways unsubtly, alluding to this message. The markets have to go down sometimes for you to be getting the upside. There's no other way to get it. You cannot reach financial nirvana without going through these shitty periods. If you don't want the shitty periods, stick your money in cash, and I'll see you under the railway bridge in 30 years' time. Use consistent language. The declines are temporary. The advance is permanent. They're not investing in the stereo stock market. Never use the word stock market. They're investing in the great companies of the world. And that's the ongoing process. During the temporary declines, as we've said already, you've got to be on the front foot. You cannot be waiting for the emails to start pouring in and the phone calls to start pouring in. You've got to be out there saying, okay, have a company barometer. Maybe when the markets, whichever market you want to define, the S&P 500, the MSCI world is down by, say, 15%, you do a little video to your clients, just a video saying, just to let you know, I'm conscious of what's going on. Everything's fine. This is totally normal. This is the average intra-year decline, blah, blah, blah. Just so they can look in the whites of your eyes, a video and an email, stick it out there, end of, nothing to worry about. When markets continue to decline to maybe 30%, do another one and say, okay, it's a little bit more hairy out there, isn't it? If you want to have a consultation with me, let's meet online. We can talk it through. We can look at your financial plan. Go on.
Let him finish. You're on a roll here, Nick. I'm enjoying this.
And there are three. And also, if you can, in all these communications, talk a bit more slowly, lower your voice a bit more, and use a bit more humour. You've just got to radiate confidence that this too shall pass. They are looking to you. You are the sole beacon of hope in a world that's full of Robert Pestons and Beth Rigbys screaming at them that this is the end of times. You are the salvation. You are the shining light on the hill, and you've got to radiate that line down to your clients. And you've got to believe it. If you don't believe it yourself, you're never going to be able to convince anybody of anything. And finally, there are three key messages during a nasty decline. This too shall pass. Number one. Number two, if your financial plan and objectives haven't changed, then we do not change your portfolio, okay? The portfolio drives the plan. The plan's not changed. We're not changing the portfolio. Third point, the great companies are still great companies. You're still spending money on trinkets you don't need from Apple today as you were yesterday and will do for the rest of your life. They're great companies. It's just this collective thing, we use the word once, the stock market, it's just having a bedwetting session where people who shouldn't own shares are selling them and they're giving them back to you at reduced prices. Count your lucky stars. Nothing's changed. And the final thing is get the cash flow out. Get the cash flow and just show them. For those clients that are nervous, really struggling with it, just do the cash flow. Look, the market's down 30%, and it's amazing, actually, using the cash flow in the long term, how little difference it makes for clients. It might bring the red years a few years earlier, 30 years hence in their mid-80s or something. When they see, you know what, it's not that significant, it doesn't really matter. But just be empathetic, use plain language, and be a voice of reason and light. And that'll get people through, but you've got to go into these markets believing all that stuff, okay? It's not an act you put on. And that's how you do it. And I don't know really why it's so difficult, but it seems that some people struggle with it, I guess.
Well, I'm glad someone prepared for this podcast.
Well, I made the mistake of reading what was in the meat and potatoes and then acting on it. I mean, I know it's a novel concept.
Well, it was added about 10 minutes before we pressed record, but yeah.
Nick, your final point saying this seems easy. You have spent thousands of hours in this business, this profession.
That's true.
And you've read a lot. It's like the concert pianist going out there and doing a show and getting a standing ovation. He walks off the stage and says, I don't know what the big fuss is about. They're experts in their field. You're an expert in your field. So I wouldn't underestimate, how much time you spent to become a master at looking after clients during these tough times. So back to practicalities of we're in a decline now. I've not changed my client communication. Obviously if clients are communicating with me anyway, I'm in that cycle. I'm doing a monthly newsletter anyway. Back to Alan's point, which does make sense. If you have a handful of clients that will be losing sleep at night, then maybe I'll be on the front foot with them. Luckily, I don't have any of these clients that are banging the door when the market declines by -5%. So far, I've not yet changed my communications, my cadence, my rhythm, or my communication rhythm with clients. During COVID, I did. That was completely different.
Oh, absolutely.
On the front foot. That was a different space. So far in the decline of 2025, I've not changed anything. But as I say, every single communication I've ever had with a client from day one, they've got the truth about the investment markets, reiterated some of the numbers, and obviously explained that the markets will be kind to you long term if you're disciplined and patient. Any other points?
Not really. Just to close on this, I think it's a very important point, actually, you've kind of raised there without perhaps meaning to, is that the communications must go out at a meaningful inflection point. Don't start sending out communications when the markets are down 5%, because that's just adding to the absolute noise.
Yeah, that's what I'm saying.
Yeah. Okay, cool.
That's what I've always said. Our communications go out saying, ignore the noise.
Yeah, don't panic. Don't panic. Don't panic email.
More noise coming in. I
wasn't panicking before you sent me the. I mean, I use Transact predominantly. When I log into Transact, I can see when my clients have logged in. So it's one of the things I look at at least weekly. Some of them are constantly logging in anyway prior to the declines. Most of them are not, thank God. But most of them haven't logged in for a couple of months. Like this big decline that the financial world's talking about, and I ring up my client who's sitting there doing gardening. Have you seen all the news? Yeah,
no, Andy, everything's fine. I was having a lovely time.
Yeah, no, exactly.
But just whatever you do, don't panic.
Okay. 77 minutes in. I think it's time we move on to the next segment of the show, which of course is Trappist Questions. And this is where we answer questions posted by you, dear guys and girls. There is the post lady at the door. She's hauled the bulging sack of Trappist questions up to my front door. If you want to submit a question, please do. The link is in the pinned tweet on X, or the pinned X on tweet, whatever you want to call it these days. It's also in the so-called show notes. We go through them as much as we can. We can't go through them as quickly as we'd like sometimes, because some of the questions are longer than others. And today, well, the envelope is extremely heavy. I'm going to really rip this one out. That letter opener's bending. There we go. Crikey, look at this. A War and Peace effort. This is from a lady called Beck Fiddy. Now, guys, this is you guys. If you've still got the agenda open, I've colour-coded this. I'm yellow. Alan, you can be...
No, you did the whole thing.
I'm not reading all that.
You've got this now.
I'm yellow. Alan, you can be blue. Carl, you can be mauve. And Andy, you can be the uncoloured one.
I can't, because I don't have the agenda.
Oh,
he did not get the agenda. Right, Nick, you do your best, mate.
Do you want to do? I'll do a bit.
I haven't read the question either.
Right,
so
okay, Alan. I'll go down to my last word. My last two words will be 3,000 holdings, and then Neil's taking over. Okay.
Yeah, good.
All right, okay.
Half and half.
Right. So Beck Fiddy, who's on LinkedIn, her LinkedIn profile will be in the so-called show notes. She asks this novella. Hi guys, I'm a recent graduate new to the industry and currently working as an administrator. I've been loving listening to the podcast and I'm enjoying gaining extra knowledge by being part of the industry. Profession. The research I've done into the efficient market hypothesis and my current experience as an investor has led me to the conclusion that the rise in indexed fund investing has made the markets less efficient. The clear shift from active to passive, further fueled by the recent rally in indexes as a result of the AI theme, has created bubble-like valuations in certain names. An efficient market would mean that overvalued holdings would be sold, but this isn't happening due to the endless liquidity flowing into passive funds. Stick with us, folks. I see that a lot of fund managers are concerned about how this ends. Are there managers like Dimensional that have active global equity funds which are as diversified? Rather than having to have large exposure to the potentially overvalued equities, which is present in passive funds like the FTSE Global All Share, where the top 6 holdings account for over 17% in a fund that has over 3,000 holdings.
Oh, sorry.
Nick, are you ready, Alan?
Sorry. As I've only worked for
Such
one
seamless.
As I've only worked for one IFA firm, I'm curious as to what approaches other firms take. Does a mixed approach of both passive and active fund management exist? I feel that having the bulk of a portfolio in a low-fee global diversified fund, I've read that Alan has his whole pension in a Dimensional Global Equity Fund, which looks great. That's almost true. I've tweaked it, but yeah, that's true, which makes complete sense. Thank you. However, I also think there's merit in allocating a smaller percentage to an active style for market cycle investments or specific regional investments. This way, you can actively participate in outperformance, as we've seen recently in Japan and India, and invest with the leading fund managers. You can also position for market cycle movements. For example, selecting the leading fund managers for rate-sensitive US sectors like biotech and small caps for the inevitable rate cut cycle. Here comes the question.
Well, hold on.
Does it say that?
About 14 questions.
Well, okay. Is this method of portfolio management common, or are advisors typically sticking to either a passive or an active style of investing? I'd love to hear your thoughts, and thank you for all the informative content you produce. Great question, Nick. Over to you.
No.
Right, thank you for your question.
And on to what many people call... One canard.
Try to unpack it.
I think I might have got this. Maybe I've got this wrong. The efficient market hypothesis doesn't mean that markets can't go crazily overpriced or overvalued. The EMH is saying it's very hard to identify mispriced securities. The end. That's what it is.
Exactly.
I mean, answer your questions.
Look, I'll just narrow in on a point. If I sort of just unpack some of the things, it's and I get this honestly as was it Beck? She's new. Obviously, she's new to the thing, and we've all been on a journey. I've certainly been on a journey. And when I was beginning to investigate, there's a better way of investing. There's an improved way, a more efficient way. It intuitively felt right to me. I got the sense that large liquid markets like the US, like Europe, UK, hard to beat the market. There's too much information, but surely it makes sense. Less research markets, small cap, Far East, emerging markets, things like that. There must be an opportunity to capture alpha. There's all these fund managers that have got base in Hong Kong or something, and you think, well, we're sort of on the streets. We understand this stuff. We can add value through active management. All roads lead back to data. Everyone's got an opinion, but what is the evidence and the data said? And there is just report and analysis after analysis, year after year, decade after decade, that it is very, very difficult to capture above market returns in a consistent way through using active stock selection. That's just what the evidence says. No one says it's impossible, but it's very, very difficult to do so. So we all end up with a position which, and actually the interesting thing is, that we've got this company which has been mentioned several times called Dimensional, and it's, the jury's are they active or passive? I would say they're an active manager. Our portfolios for our clients are predominantly the Dimensional and Vanguard. Vanguard are really capture market returns at super low cost, and Dimensional offer a tweak to that in a sort of active strategy by tilting towards sources of additional expected return in the form of small cap and value. So I think it's an optimized blend that we've got. It is arguably it is a bit active passive, but it's not active in traditional sense that we're going to go and find some individual stocks because of the market cycle or biotech. I think honestly, frankly, and I'll be blunt, you're wasting your time. Interest rate cycles, biotech, India, You're just trying to over-engineer something. Absolutely. You're trying to solve a problem that doesn't actually exist. The problem's already been solved, really, and capturing market returns in the way that we all do.
And Beck, so imagine you manage to find that needle in the haystack, that active fund manager who can deliver alpha over an extended period of time with an India fund, and this he or she delivers a return above the Indian stock market, and you've got 0.5% of your portfolio in India. So what? All the agony of trying to find that active fund manager. It's just don't. Just buy the world, stare out the window figuratively, and come back in 30 years' time.
One minor point into our question. It sounds like a very smart and intellectual question, and as Alan said, everyone's at a different journey in this. The road to hell in this business is splitting your AUM advice between half passive and half active.
Correct.
Like, choose your camp. If there's two leaders, there's no leader. So you got to believe in, what you're telling the clients to do. So splitting your investment advice to half active and half passive, I think is a massive no-no. But yeah, he's obviously on their journey and they'll tweak it. But me turning off active management early on in my career is the best thing I've ever done.
Yeah.
And just buying the globe for as low cost as I can, and asset class investing has been a complete game changer for me, my career, and my clients. And now I can focus on all the other stuff. There's enough stuff to do in this business, let alone tinkering around, trying to get a tiny bit of outperformance here, there, and everywhere. Because in the end, it will all just revert to the mean anyway. So, Nick,
just going to tie a bow on this, Carl. You're happy with this?
Yeah. Well, I'll just language matters, right? So we're trying to take the passive investing phrase out of it and call it index investing, because passive sounds like that, there's no decisions being made. So I think that's really important. And I think as well, our dimensional active, I'd say they're evidence-based investors. And I think if you can tell your clients you're an evidence-based investor, you've compiled the evidence, you've done the research, and here's what your research has led you to come to these conclusions. I think that the conclusions you'll come to are that a Vanguard dimensional, whether it's a Monday index funds, that kind of stuff, that's where you will land. But it's, hey, I only discovered this 15 years ago, and I'm in this business 30 years. So there you go. You're finding it out way sooner than I did, Beck.
Yeah, absolutely, Beck. And we all take our own journey to get here. I'll just reiterate it once again. I know a gazillion advisors have gone from active to passive. We all know a gazillion advisors have gone from active to passive. None of us know one advisor who's gone back. Okay, let's move on to the final segment of the show, which many people call Culture Corner, which is hanging, which is awkward.
Come on.
There we go. Let's be quick on these, guys.
Steve Jobs, I don't have the agenda, but I know it was me because I put it in first. Alan mentioned this. It was his address to the Stanford Business School, I think.
Bloody good.
I had never heard it before. It's 14 minutes of inspiration. It's on YouTube. Check it out. Absolutely brilliant.
I highly recommend the Jeff Bezos one as well at Dartford. Again, another insane talk. Sorry, over to you, Alan.
Lovely. Thank you.
Yeah, the Steve Jobs one is reckoned to be the best commencement speech of all time. My Culture Corner is my colleague, Shireen Harb, who was she's my Chief Operations Officer, COO. She was interviewed on another mention for the famous man, Abraham, on his podcast, Advisor 3.0.
Love Abraham.
And
Can't get enough.
She, Shireen, who's an outstanding character, very lucky to have her on the team and running her operations. She's been through this journey. She's from Saudi. She went to the United States, came to London. She's had an incredible personal journey and life, and she shares all that, and it's very inspiring. It's only about 30 minutes or so. It's a great podcast.
Yeah,
check it out. Advisor 3.0 with Abraham and Shireen.
Shireen is outstanding. Highly recommend that.
She's
okay.
Good. She keeps the whole
Next
together.
single recommendation.
No, I've got a couple of points.
Every time you got a couple of points.
Be quiet. Sam Bankman-Fried, who we spoke about quite a lot. FP. What was the company?
FTX.
FTX.
I'm a crook.com.
I know, very interestingly. Okay, so he was interviewed by Tucker Carlson in the US inside prison. It's definitely worth listening to or watching on YouTube. Had his company not have been closed down, the company would currently have liabilities of 15 billion, but assets of 93. It's an insane. Obviously, what he did was wrong. He's gone to prison for a long time, but it's just this odd thing where he's created more wealth for the people that he's meant to have scammed. It's a unique scam. I think it's insightful. Anyway,
maybe that's what that advisor in Portsmouth is hoping for. Just hope the markets were. Oh, sorry,
I was that close to pulling it off.
Yeah, I bought properties in my own name that went up loads. Now you can have them back. The next one is, I've shoehorned it in. Charlie Munger has got a famous book called Poor Charlie's Almanac. It used to be a nightmare to get hold of. The book was like 15 kg. It came from America and cost about £4,000. Now they've made a new version of it. It's on Amazon now. It's on Kindle for 99p. And the Stripe brothers have written a foreword for it. And you can buy it via Stripe Press. Something I learned today. Stripe Press is a new thing out. Stripe, the digital money company, coming out with this press sort of feature. Anyway, so
words
buy
with
it.
no real coherent meaning. But do continue.
Thank you. So buy it on Kindle for 99p. It'll be the best 99p you spend in your life.
I did mention that in the group WhatsApp a few weeks ago, didn't I? Yes, I did. Okay, and my one quickly. White Lotus is out. The season 3. I've been a bit slow on this, but the first 2 series were very good. And if there's nothing else to watch on TV, watch White Lotus. All right, are we done? Andrew, do you want to give one more plug to something?
No.
Trap Live?
Yeah, Trap Live. Okay. Yes, so Trap Live people, please. I thought you were just taking the piss, but anyway, let's tie a bow this episode.
Sell these tickets, boys.
So yes, we are in. Let's put on a great show. Let's respect your time. We'd like to see you live in person. Grab your tickets.
2 free drinks.
2 free drinks with every ticket.
Or non-alcoholic.
Alcoholic and non-alcoholic. Alan, do you want to just close it up, mate? Go on.
This is what it's like when I try and close. I'm loving
this. Do you know what I mean? This is just like...
You're
going to close it up, but...
I love it.
This is like going for a drink with those 2 boys.
It's relentless.
Talking over each other, finishing each other's sentences. It's like, and myself and Nick tend to...
Honestly, you go for a pint.
It's true.
You go for a pint with Alan. You've been there for half an hour. Your pint is empty. His pint is freaking full. It's like, look, you are not talking until that pint is halfway... Sorry, stop talking until that pint is halfway done. Anyway,
that's because I think he breathes through his ears.
I don't drink as much as you. I'm a corporate athlete.
Go to corporate athletes. Please go to therealadvisorpodcast.com and grab your tickets. We will see you live 14th of May, 6 p.m. The sun will be out in the greatest city in the world. We cannot wait to see you. Over.
Is it on in Dublin?
Great stuff.
Good
right.
night.
So, Ultra, you've got to go
wrap
pick the
up this
Rugrats up. Dear Trappist, thank you for listening and surviving to the end of episode 66. Another pile of traps slides down the U-bend of Father Time. Please do leave a review on iTunes or whatever app suits you best. 6 out of 5 stars is mandatory. Otherwise, you'll be whipped thoroughly. But until the next time, dear Trappist, adios. We'll see you on the other time. Au revoir.
Bye-bye.
Bye-bye.
Goodbye. Well done, Nick. Good effort, mate.
That was good, wasn't it?
Good effort for a
That was a good show. That was fun.
bronchial man.
For a man who's got bronchitis.
I'd
Yeah, it
say
was
he
all right.
doesn't.
It's quite funny.